All right, we've done a bunch of videos now on options. In this video, I want to actually cover just some nuances, some unusual stuff that can happen when you're transacting in options. And we're going to cover three topics in this video. One is early assignment or early exercise of an option. The second is a corporate action or a special dividend that can change the deliverable that you have to deliver, let's say if you've sold a covered call. And then the third topic, we're just going to cover some nuances on taxes. Okay, so first of all, early assignment. What's that? Okay, with any option, there's an expiration date, right? And most options, if they're in the money, they get assigned or exercised at expiration most of the time. But you know, let's say you have a covered call that you've done. You own 100 shares of XYZ stock, and the stock pays a dividend. And let's say the stock is in the money, so you buy the stock at 10, the call that you sold is struck at 11, and the stock goes to 15 or whatever. And so the person can exercise this option at any time, the person who's on the other side of your trade who's bought the option that you've sold. And so a lot of times, if there is a dividend that is close to the expiration date, they may actually exercise their option in time to capture that dividend. And so I'd say 90% of the time when something that I've done, a covered call that I've done that's gotten exercised early, that's gotten taken away early, it's because there's a dividend payment. And it's free money that the other person has the right to because they're the one who's long the option. It doesn't always happen, but that's the primary reason when an early exercise might happen with a covered call situation. With put options, this can happen too. It's a lot less frequent. But it's just something to think about if you're selling put options. Every so often, in my investing career, it's maybe happened 2 or 3 times, so it's not very common. But every so often, you can have an early assignment of stock. So you've sold a put option of a company. The option is in the money. And instead of it being assigned to you at expiration, it actually is assigned to you sometime before expiration. And who knows why? I mean, maybe the person on the other side of the trade wanted to get the stock, you know, sort of get rid of the stock sooner. Maybe, you know, who knows what their reasons might be, but it doesn't matter. It's just that this is a risk that you can bear. And sometimes you may be accountable to buy the stock before you think you will, before you think you might, or before expiration. So keep that in mind. Every once in a while, a put option can get assigned to you, you know, a put can get assigned to you early, and you have to take the stock and pay for it ahead of schedule. So early assignment doesn't happen that often. It really doesn't happen very often with put options, but it can happen, and it's a risk to be aware of. Okay, the second topic is special dividends or corporate actions. So I just recently had an example of this with the company Stellantis. This is actually a daughter company, or it was the company produced with the merger of Fiat Chrysler and Peugeot. And this company announced, and what I had done is I owned stock in Fiat Chrysler and had sold a covered call. And so Fiat Chrysler announced a special dividend that had to do with this combination of Fiat Chrysler and Peugeot. They announced a special dividend to their shareholders. And I had an outstanding covered call in Fiat Chrysler. Well, so the ticker changed, and then what happened is the deliverable changed. So instead of just giving up 100 shares of Fiat Chrysler when this stock was in the money and it expired in the money, I also had to give up this special dividend. So it was a little bit weird. I got paid the special dividend when the dividend was issued, but that also became part of the deliverable when the stock was called away. And you can also find this a lot of times if you click on the link to the actual, like on your broker's website, there'll be an active link for any option. You click on it and you can see, you know, the trading activity, the open interest, and you can see what the deliverable is. And when it's just a regular stock, it's 100 shares per contract, right? But in this case, it was 100 shares plus a couple $100 for this special dividend, which I had already received before, okay? So in a lot, like in life, there is no free lunch. In this particular case, the special dividend, because it was announced after the contract for the option was issued, the holder of that call option that I had sold has the right to these kinds of corporate actions. Whereas a regular dividend, they're not going to get that dividend unless they exercise early because that was known before, okay? So certain corporate actions can change the deliverable for the option that you may have sold, But usually it's just whatever you got, you have to give back when the actual option exercise happens, when the assignment happens, okay? And then third, taxes. On video number 60, we did actually just a discussion of choosing which lot you're selling when you make a sale of a company. And I went through an example with Schlumberger where the stock has been at all different types of prices, and you can imagine a situation where you've bought it at low prices and bought it at high prices, and after a move in the stock you may want to trim back some of your holding, and you can actually pick which lot you are choosing to sell, right? You have to choose it before you actually make the sale, but you can choose, for example, a lot that would involve a tax loss if you want, or a tax gain, and it depends on what your tax situation is up to that point in the year, what you think it will be over the course of your year. Generally, I try to book losses early on in the year, but this is, again, it's a matter of taste. But in the case of a covered call, for example, you don't actually get to choose which lot. So, for example, let's say you bought 1,000 shares of company XYZ at $10, and you sold a covered call on 100 shares at 11. The stock goes to 15. And so you know that 100 shares, you have to deliver 100 shares of the stock at 11 because you sold this call option. Now, what the broker's going to do is they're going to pick FIFO. They're going to pick the first lot that you sold. They're going to assume that the call option was sold on that lot, and then they're going to take away that particular lot. You don't get to choose. And so this is another thing to think about, because a lot of times, you know, maybe if you've bought a stock over a series of different prices and that price has gone up over time, by choosing the first lot, the FIFO lot, it's going to be your lowest priced option. So you're going to pay the higher amount of taxes as a result. And it's just a thing to think about. You don't get to choose your lots like we described in video number 60. The broker does, and it's always FIFO, okay? So these are three just sort of nuances to think about when it comes to options. It's a good domain. It's actually really, really helpful to kind of make you a more sophisticated investor. There's lots of things to learn with them. So, and we'll keep doing videos on options as I get ideas for them. But as always, I thank you for watching, and I hope these videos help.